Good morning. It's lovely to see you here. Indeed, congratulations on getting here, given the number of late night parties which are apparently occurring around this town last evening. My name is Tim Hames. I'm here with 17 Capital, who are on level 2, booth D442, if you're interested. And it's my pleasure to serve as the chair for this morning's group of sessions on asking the allocators. There are very few subjects which are more important, and even by the standards of IPEM, we have a packed and diverse program. We're going to start with the portfolio for the future towards a new allocation paradigm, and it's my great pleasure to introduce as your moderator, Cameron Joyce, Senior Vice President, Deputy Head of Research Insights at Preqin.
Excellent. Thank you very much for the introduction, and thank you all for joining the panel today. As introduced, I work on the Research Insights team at Preqin, which is, we're responsible for publishing institutional research as part of the Insights Plus product that we launched a couple of years back. I think we'll start with introductions. So perhaps, Guy, if you want to take a moment to introduce yourself.
Yeah. Hello, so I'm Guy Lodewijk. I'm heading the private market multi-management business at Amundi. So we manage about 12 billion euros. It's mainly private equity, and then infrastructure, real estate, and private debt.
Hello, everyone. Good morning. My name is Garvin McCarthy. I'm Mercer's Chief Investment Officer for Europe and Asia, and have responsibility for our investment solutions business, where we're allocating capital on a discretionary basis to build portfolios for clients that are looking for outsourced implementation. That covers globally about $450 billion today across a range of traditional and private market asset classes, and across this region particularly a significant volume of clients allocating to private markets, equity, debt, real assets, and impact.
Good morning, everyone. I'm very happy to be here. Actually, I wanted to start with thanking the organizers of this event. It's the last day of the conference, but I think it's not too late to say thank you to Antoine Coulson and his team for a job very well done. I'm Alona Ponomareva. I represent the World Bank Pension Plan. This is a corporate pension plan which is run pretty much as an endowment in terms of our very significant allocation to all the alternatives. We've been around since the 70s and in investing in private equity since 1981, and investing in private equity in Europe since 1985. So it's a very well-established portfolio. We have about 40 billion in assets under management overall, and about 10 in private equity. And I represent the team, that invests the private equity portfolio, and I am in charge of the European portfolio.
Excellent. Thank you very much for the introductions. So to start with, if we look at the long-term trend with alternatives, I think we're all fully aware of what's been happening. Allocations across institutional investors have been increasing significantly over the last several years, and I think that's pretty much confirmed with our data as well. Both the depth and the breadth of allocations across private capital has really increased markedly over the last several years. So I think obviously the backdrop to that has been very, very positive. We've seen extremely low nominal interest rates. We've seen negative real yields in many respects. So that's clearly been incentivizing allocators to put more and more into private capital. Now, I think we're all fully aware of what's been happening with the macro. We're not going to go too much into the detail there. But obviously things have changed, quite markedly, and let's not talk too much about the inflation debate, but clearly we're in a new situation with the macro environment. So my first question is really around allocations. So strategic allocations to private capital have been on the increase, private equity included. So Alona, to start with, maybe you could touch on your view on whether or not the current macro environment is likely to have an impact for investors, but both on a tactical and more of a structural basis as well.
Yes, sure. So I think you're very right. Long-term trend is extremely positive for all private markets, and especially for private equity. In our own experience at the World Bank Pension, where we've been investing for plus years, this is the best performing asset class. It has been a key contributor to the returns of our pension. We would not have gotten to our objectives in terms of returns without this asset class. And I know we're not the only ones. So over long term, absolutely, I think this trend is going to continue. There are more and more pools of capital interested in getting access to private equity. We're all aware of all these trends. So I don't think there's any danger for private markets all of a sudden losing, that allocation from the various pools of capital. At the same time, speaking on a more tactical short-term basis, and also from our own personal experience, it's very clear that over the last several years, the allocations have increased, and it has primarily been because of the great performance. So the net asset value of our portfolio has been growing due to fantastic performance, and we have become over-allocated, our specific pension plan, and I know we're not the only ones. So because of that, we're somewhat limited, restricted in what we can do, but I think it will only be a fairly short-term effect, maybe 1 or 2 years, and eventually, of course, we will continue, and we are continuing. It's just that we cannot step up. We all understand the importance of staying in the market. We've been through this before, the GFC, when some of us had to step out of the market because of over-allocation, and that was not the right decision. So we've learned from that. We're continuing to invest, but we have limited ability to increase our allocation. So that, I think, is the short-term effect of what's been going on in the last 6 months.
Okay, and Garvin, anything to add to that? Would you?
Yeah, no, I think Alona sort of highlights a couple of really key points facing allocators in the short term. I think ultimately the denominator effect is having an impact on re-ups. I think the lessons learned from '08, as Alona sort of indicated, are sort of still relatively fresh in people's minds. So whereas we're seeing clients continue to allocate and strategically build portfolios, they're certainly keen to keep key GP relationships and keep their allocation slots, even if they're trimming their tickets in the short term to reflect maybe internal or allocation rules. So I think that's possibly a short-term phenomenon, but something that obviously is influencing people's current allocation decisions. I think the points were well made on private equity. I think we're seeing that also play through right across the private market spectrum, be it private credit, real assets. And I think we're seeing people understanding that this is a core part of their portfolio for the long term and buy into the benefits, be it diversification, yield, inflation linkage, to Cameron's point, and ultimately return enhancement. So not sort of, getting spooked by the fact that allocations on a relative basis may represent a larger proportion of portfolios, but acknowledging that with public market sell-offs, that they need to be a bit more active in managing the size of their re-up commitments and their programs. So that's something that we're seeing a lot of clients deal with at the moment.
Okay, and Guy, we'll move on to talk more about the specifics of within the private capital asset classes. But anything to add on that overall point about strategic and tactical asset allocation?
Maybe two short points. The first one is that I don't believe that it works to do market timing. So of course we all know that it's expensive today. Probably less than a few months ago, but it's still expensive. But we don't think that market timing works on these asset classes. First, because when you commit to a fund, it takes 4 years, let's say. Officially it's 5, but it's very often 4 years to deploy. So I have no idea of the average level of the market in the next 4 years. And the second point is that we need to trust the GPs when we invest in funds. They can switch from one sector to another depending on market conditions, and so I would say no market timing. So this is the first point. The second point is that with most of our institutional clients, we see a willingness to increase their overall position, to the overall exposure to private markets in the long run, and it can be very, very large moves, moving from, for for some of them from, say, 5 to 10%, so it's huge. So anyway, we do believe that we'll continue to see these inflows from institutionals. And the last point that I wanted to mention is that there's one thing I believe that should be taken into account when we reinvest year after year. It's the distributions. If the distributions slow down, then we should probably slow down also in the reinvestments, because if you don't do that, after a while, the situation gets out of control. You don't have the right equilibriums in your portfolios, and so this is probably the most important thing to look at. It's distributions.
Excellent. Yeah, that makes a lot of sense. I think at Preqin we're very much on board with that view overall, that performance and fundraising probably will slow, but that, you know, the case is that's probably the case for public markets as well, and it's more of a short-term thing. I suppose the next thing is that we've also noticed that there's definitely a relative shift more recently towards real assets. So obviously, you know, for the near term, I think private equity, venture capital is looking a little bit more risky, and there's certainly a lot of appetite for private debt as well. But Garvin, what do you think about that, you know, potential shift within private markets?
Yeah, no, it's certainly something we're observing with our client allocations. I think, you know, across the real asset sort of sector, you know, for a long time people have had meaningful real estate exposures, certainly, you know, across Europe and beyond, usually at least starting domestically, and then, you know, over time have built out more global portfolios. In the last 10, 15 years, particularly sort of the expansion in infrastructure has been very noticeable in terms of the asset allocation activity of clients, and I think many are much more comfortable now with the role infrastructure as an asset class can play in their overall strategy. You know, the defensive cash flows, typically the regular inflation-linked income streams, the defensive properties on average, are characteristics that I think people really, you know, value, certainly in pension and insurance and institutional portfolios, but also even in, you know, the private banking and wealth management sectors. I think what we're seeing, the overall allocation trend is for growth. I think the same dynamics we just talked about are still influencing allocations. One thing I suppose to note is we are seeing maybe the more sophisticated investors use more tools in the toolkit, be it, you know, secondaries as both an entry and an exit point, depending on how they're balancing their portfolios. And also, you know, co-investing, I'm sure we'll talk about throughout the panel today, continues to be a big area of focus to enable investors shape their portfolio. So, and that continues in real assets as well. So, you know, certain parts of the market, certainly on the core end of infrastructure, valuations, you know, continue to be, you know, elevated. But you've got competing pools of capital, be they direct investors as well as GPs competing for, you know, scarce assets, particularly at the larger end of the market. So you need to be mindful of that, but I think in general the support is there, and to Guy's point, we're building, I think, investor allocations from 5 to 10%, and that mega trend is something that will continue to build.
Absolutely. So again, I mean, obviously real assets is very much your focus. So in terms of what have you seen more recently in terms of investor appetite, you know, within real assets, and what?
It's definitely infrastructure. The asset class that people are looking at more and more, it's infrastructure, because it's well, several things. First, I believe that there is a room for a lot of extra performance on infrastructure, because you have a lot of assets that were owned by corporates or governments, and of course when you put that, it's like a first time primary LBO. When the company goes to an LBO for the first time, there is a lot of upside, and we have exactly that situation in the infrastructure market. Many assets entering the market, and upside from build-ups, from optimization, new management team, etc. So this is one reason, it's performance. The second one is low volatility. I'm not sure that the combination of these two things will last forever, but at least for the next 3-5 years, I believe it's going to stay this way. And then the very important point also is that infrastructure allows to have an impact, and an environmental impact, a social impact, mostly environmental, because social infrastructure, it's only a very small part of the market. But so the ability to have an impact locally, you know exactly where you have an impact, you can measure it, you can communicate on it. This is also important, and this is a very strong driver of the inflows in infrastructure, I believe.
Yeah, I mean, that ties in quite nicely, I suppose, with our next topic, which is ESG. And I mean, obviously, I think looking across private capital, infrastructure is one of those asset classes with a higher level of transparency, which obviously helps with the implementation of ESG strategies. So specifically in Europe, Guy, you know, to stay with you, in terms of what trends are we seeing there? And because again, you know, it's another mega trend. We've seen a huge adoption of ESG, you know, primarily coming from LPs, the demand coming from LPs, and we've seen increased adoption across private markets. What about now? I mean, clearly, there's an increasing trend of more scrutiny on ESG policies, more scrutiny on managers. In private markets, obviously, we still have a challenge, you know, with the lack of data available in the market. So, how are you seeing that play out?
Well, you said the important word. It's data. We like data. In Europe, at least, the regulators are trying to normalize that. So we have all these KPIs that we all will need to produce for our clients. And so this is something really important. It's getting measurable. A few years ago, it used to be a constraint. So exclusions of the worst ESG, the worst funds in terms of ESG. Today, it's not a constraint anymore. It's something that we will need to optimize. And this is a very interesting point, I believe. We will have to optimize both performance and ESG criteria at the same time. At least it's what we are asked for in Europe. And the good point is that very often we see a positive correlation between good ESG practices and good performances. So this is the good point, because at one point in time anyway, we will probably have to choose and to put different weights on ESG and performance, and this is what we are getting asked more and more often.
I suppose, Alona, in the US, it's a very different picture in terms of ESG adoption, and we've certainly seen some, you know, discussions about maybe a change in approach from the regulators, especially in contrast to Europe. How do you see things, in contrast to Europe?
Yeah, I would say we're slightly behind in the US. Hopefully we will catch up. And at the World Bank, you know, we have a global portfolio, obviously a global mandate. For us, ESG has been important for quite some time. We also see, and it's not just in the US, how some of the GPs sort of redefine themselves from just being a generalist, you know, private equity fund to becoming a sustainability-driven private equity fund, while not necessarily changing what they're investing in. So those are, you know, interesting developments. On the LP side, you also see kind of two groups of LPs potentially. Some that are the so-called early adopters, which actually have a formal allocation to maybe impact funds or, you know, climate funds or, you know, ESG driven funds, and others just want to ensure that their whole portfolio is, you know, driven by the general approach to be more sustainable, but don't necessarily have a specific allocation. And they're also likely waiting for some more definitions and data, as has been mentioned. We are in that second group. We don't have a specific allocation to, you know, impact, for example, but we're certainly keeping close track to what's happening in the market, you know, meeting the managers, trying to understand how various GPs are approaching this. So that's our situation.
Okay, and Garvin, anything to add on ESG?
Yeah, look, I think, you know, you mentioned it and the panelists have covered a lot, but, you know, for us, it's been core to our investment policy and our process for, you know, for a couple of decades now. You know, when we review managers, we underwrite them. We ascribe ESG ratings as well as investment ratings, and have done so for close to sort of 20 years. What we are seeing, I suppose, from a regulatory standpoint, to Guy's point, I think the acceleration we're seeing in how the industry is changing because of regulatory change, has really fast-tracked, I think, the integration. Because for a long time, it was talked about in a sort of a nice-to-have way or a sort of secondary decision-making input. But now I think it's becoming core to allocation decisions. The integration of ESG, the SFDR status of a particular fund offering is really becoming a criteria some investors are looking at when they decide to allocate their capital. And that's really been a meaningful shift, even in the last 2 years, as SFDR has really sort of taken hold. And I think sort of one thing, as we talk about mega trends and the increased importance of private assets in total portfolios, I think the realization for private equity and private market managers is they will be held to account in a much more rigorous way on data and fees and transparency that traditional asset managers have had to deal with for a long time. And whereas before, the private markets industry was a smaller subset that could sort of get away with not being held to the same account. I think now that is changing, and the sort of maybe the flip side of getting bigger as an industry is the profile is rising, and regulators are going to put more scrutiny on the asset classes. And that's going to mean more investment in data, more transparency to investors, more transparency on fees, and ultimately, I think, a change for the industry. And we're starting that, certainly in Europe, and I think in the US in time as well.
So moving on slightly, so obviously, we've talked a lot about the allocations that institutional investors are making, and but I think the way in which, we alluded to it before, the way in which investors are gaining exposure is changing, right? There's a lot of innovation in the space. We're moving away from these traditional fund structures to a lot of other, innovative structures as well. So, Guy, let's start with you in terms of what do you see in that space, particularly with real assets, and what trends are we seeing there?
Well, the main trend that we see is that there are more and more tools that we can use to build the allocation. There are two things that we use these tools for. So first, what am I talking about? I'm talking about continuation funds, secondary transactions, co-investments, open-ended funds. We do like open-ended funds on the low volatility asset classes, not on the. If you have an issue about the valuation, open-ended fund is probably not suitable for institutionals at least. But for core infrastructure, for core real estate, for private debt, it does make sense to have these open-ended funds. So these are the tools that we are talking about. So that allows to readjust the exposure of the portfolio when needed to increase the speed of the ramp up, and also, and this is a very important thing, I believe, it allows to reduce the fees. I'm especially thinking about co-investments. And the fees the fee level is getting an issue for some of the real money investors.
Okay, yeah, interesting. So it's almost like there's fee pressure, but it's very much indirect by LPs circumnavigating traditional structures. Alona, in terms of private equity, are you seeing the same trends in your markets as well?
No, absolutely. It seems that for a while now, it's really not enough for a private equity program to just do primary fund investments. You need at a minimum co-investments and ideally a range of other types of structures and vehicles. In our program, we do have co-investments. We have secondaries. We're not necessarily super sort of early adopters of some of the other potential ways of accessing the market. Like we don't do direct investing. We're not the Canadians. We don't have 55 people focused on direct investing. And I'm exaggerating potentially. Nobody told me they have 55 people. It's just a figure of speech. So don't quote me on that. But in fact, yes, the industry has evolved. The range of offerings is much broader. And in our portfolio, what we have observed the most drastic development has been the explosion of continuation vehicles. This can actually be helpful because often these are very old funds which are sitting in the portfolio and not really doing anything. And in our case, because we're over allocated, every time we have the opportunity, we take liquidity basically, and that does help us clean out the tail end of the portfolio. So,
And Garvin, I mean, anything to add to that, first of all, but also in the retail space, we've seen a lot happening there as well. How do you see that playing out? Because it seems like it's a trend that's getting a lot of traction now as well.
Yeah, no, I think I agree with all the comments that have been made on this issue. I think, we heard it yesterday as well, the democratization of access to private markets will be sort of part of the next frontier of how integrated private investing becomes across, the entire global portfolio. And to do that, there is a need for new mechanisms, for open-ended fund structures. But I think, as an industry, we need to recognize some of these solutions that offer liquidity by investing in listed assets are, carry risk. Asset liability mismatch is possibly the biggest risk you can run as an asset manager. And if you promise investors liquidity, yet you're investing in assets that don't afford the same liquidity, you risk some of the scenarios we saw in the GFC, in gating, suspensions, redemptions, and the hedge fund to fund industry had a very difficult time during that period that I think the private markets industry needs to be mindful of, as we've seen, particularly in some areas, the explosion of open-ended funds and sort of what they can potentially offer or are perceived to offer investors. That being said, I think with careful liquidity management, good education to clients and being upfront about what is and what isn't available in particular sort of liquidity events, there is a role for the semi-liquid fund structure. And particularly if you look at private banks, wealth management, those segments of the investment community that have, in cases, been precluded from private equity and private markets because of limited partnership, 10-year fund structures, commitment and drawdown that doesn't meet the horizon or the profile of the investor. So that's, I think, an avenue that will open up allocation, but it needs to be sort of seen for what it is. I think that the real sort of fast track here may be, something in the digitalization space, blockchain technology, how that could enable more seamless secondary market participation, trading of interests, unlisted assets, to transfer them. And you mentioned secondaries. It's still a very archaic process with lots of documentation that takes several months. And you think of how other markets, public equities, trading has evolved, exchanges, that really, I think, will happen for private markets at some point. There's been some resistance and maybe some challenge, but I think, we've seen tokenization in some places, and that's carries some risks, and some investors still get quite spooked by some of those. But I think the frontier of digitalization, what it could mean for exchanging control interests in unlisted assets, is possibly the next sort of big step forward in how these asset classes are held by many more investors globally, both retail and institutional.
Yeah, excellent, thank you very much. We are running up for time at the moment, but maybe we've got some time for concluding remarks. I mean, Guy, to start with, in terms of your advice to allocators in this environment, and what other points would you make?
Well, I would say be very selective with your GPs because we have gone through very, I would say, not easy, but favorable market environments. So it's hard today to make the difference between a good track record and a medium track record, I would say. So be very, very selective. So this is the first advice that I would give. And the second one is keep on allocating, looking at your cash flows, etc., distribution, but keep on allocating whatever happens.
And Alona, I mean, I suppose as an allocator, I mean, what are some of the challenges that other challenges that might be being faced at the moment?
Our largest challenge is that we're over allocated. So, which means, our entire budget, goes to re-ups, and we cannot even give money to all of our core managers who are coming back. So we're in a very difficult situation where we have to either reduce commitments, maybe push people out into the next year if that's is a possibility, or maybe even cut relationships. And I'm talking about core. I'm talking about our core relationships. But that's a very hard position to be in. So we're not enjoying this moment, but we're doing the best we can. So to the extent that GPs have the flexibility to take longer to fundraise, I'm sure nobody would want to do that. But me as an allocator, if I have more time, I would prefer to have the opportunity to commit later than not commit at all or commit much less.
Excellent. Thank you very much. And Garvin, just to wrap up, any concluding remarks?
No, I think, stay the course. I think there's a lot of hype and hyperbole around the private markets industry. We heard talk this week of pyramid schemes. We've seen Kim Kardashian launch a private equity fund. I think the industry is in the headlines, and I think for institutional allocators, we need to stay the course. Don't get too clever on timing. Do the hard yards and diligence, and continue to invest. And take advantage of what these asset classes can bring, but understand past performance isn't going to guarantee in the future. But I think the role of private markets stays for institutional investors for the long term.
Excellent. Great. Thank you very much.